Welcome. In this video, XLM may soon increase by 250%. What is the reason? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
One of the most important areas to focus on when analyzing price movements is the resistance zones formed at certain levels. Resistance essentially shows that selling pressure has intensified above a price level, buyers were not strong enough in previous attempts, and therefore the price could not continue upward. As you mentioned, the price has risen to a certain level several times in the past, but could not go further due to the selling pressure it faced there. This situation is extremely important in technical analysis because for most investors, these levels mean psychologically strong boundaries. Before resistance levels are broken, sellers in that area constantly pressure the market, but as buyers strengthen and volume supports the move, the probability of the price breaking that boundary increases. If the price can break through a resistance zone it has tested several times before, this usually indicates the beginning of a strong rally. Because in investors' minds, a previously unbreakable barrier has been crossed, and with its breakout, both short-term and long-term buyers gain more confidence. Breaking a resistance zone usually causes significant momentum in the market's direction. Since the price has failed to pass that area many times before, finally breaking it with a strong move signals the start of a new trend. During this breakout, we often see trading volume increase as well. An increase in volume shows that investors believe in the breakout, buyers are becoming dominant, and sellers are beginning to retreat. At this point, the selling pressure above the price is broken, the upside potential increases, and as new buyers enter the market, the price can rise quickly. Especially investors who lost money at that resistance zone in the past tend to buy again once they see the breakout, because they feel the urge not to miss the opportunity this time. This further strengthens buyers and contributes to momentum. The breakout of a resistance zone often creates a chain psychological effect. Passing that level builds confidence for some investors in the market and strengthens the perception that the way up is now open. With this perception, new investors start to take positions, leading to an increase in demand. Especially if resistance zones have held back the price for a long time, once broken, the price tends to move even faster. The reason is that the selling orders accumulated there for a long time have now resolved, leaving room for buyers to fill. When resistance is broken, investors who previously couldn't get past that level see no more barrier, and the way forward becomes open. This is considered a very valuable signal in technical analysis. The strength of the rally that begins after breaking resistance depends on how strong that resistance was. If the price has reached that level and been rejected multiple times before, breaking it creates a much stronger move. Because with each rejection, investors perceive that this level is hard to break. But if the price finally passes it, that perception collapses and is replaced by a wave of confidence. This wave of confidence makes buyers act much more boldly and drives the price quickly upward. During this process, stop orders also play a role. The stops of investors who placed sell orders just above resistance are triggered, which contributes to a faster rise in price. Because the triggering of stops means sellers are closing out and buyers are gaining strength. At this point, the selling pressure above the price is broken, the upside potential increases, and as new buyers enter the market, the price can rise quickly. Especially investors who lost money at that resistance zone in the past tend to buy again once they see the breakout, because they feel the urge not to miss the opportunity this time. This further strengthens buyers and contributes to momentum. The breakout of a resistance zone often creates a chain psychological effect. Passing that level builds confidence for some investors in the market and strengthens the perception that the way up is now open. With this perception, new investors start to take positions, leading to an increase in demand. Especially if resistance zones have held back the price for a long time, once broken, the price tends to move even faster. The reason is that the selling orders accumulated there for a long time have now dissolved, leaving room for buyers to fill. When resistance is broken, investors who previously couldn't get past that level see no more barrier, and the way forward becomes open. This is considered a very valuable signal in technical analysis. The strength of the rally that begins after breaking resistance depends on how strong that resistance was. If the price has reached that level and been rejected multiple times before, breaking it creates a much stronger move. Because with each rejection, investors perceive that this level is hard to break. But if the price finally passes it, that perception collapses and is replaced by a wave of confidence. This wave of confidence makes buyers act much more boldly and drives the price quickly upward. During this process, stop orders also play a role. The stops of investors who placed sell orders just above resistance are triggered, which contributes to a faster rise in price. because the triggering of stops means sellers are closing out and buyers are gaining strength. At this point, the selling pressure above the price is broken, the upside potential increases, and as new buyers enter the market, the price can rise quickly. Especially investors who lost money at that resistance zone in the past tend to buy again once they see the breakout, because they feel the urge not to miss the opportunity this time. This further strengthens buyers and contributes to momentum. After breaking resistance, the rally sometimes continues in a chain reaction until new resistances are reached. The first broken resistance becomes the start of an uptrend, and the price begins to move toward the next target. These targets are usually Fibonacci levels, previous highs, or certain pattern targets. But the most critical point is that after breaking a strong barrier, buyers become even more courageous, because now they have a strong justification. The price finally broke resistance. This justification strengthens bullish expectations in the market and creates new momentum. In short, when the price breaks through a resistance zone that it has failed to pass several times before, it can signal a major change in market direction. This breakout represents the beginning of a strong rally because the barrier perceived as an obstacle in investors' minds has been removed. This allows the price to move rapidly upward both technically and psychologically. A resistance breakout is one of the strongest signals that a market is entering an uptrend, and breaking through resistances that have been tested many times in the past produces much more powerful results. But we cannot decide analysis only with resistance, so let's also look at the other metrics. Keep watching.
The rising trend observed on the RSI indicator is a strong structure in technical analysis that investors closely monitor, helping them see possible trend reversals or continuation scenarios in the market. RSI, or the Relative Strength Index, is an oscillator that shows whether the price is in overbought or oversold zones. It ranges between 0 and 100, and levels below 30 are generally considered oversold, while levels above 70 are considered overbought. However, one of the most important points here is that RSI provides significant signals not only in these extreme zones, but also within trend structures. Just like on a price chart, trend lines can also be drawn on RSI. And these trend lines can display structures that move parallel to price action, or sometimes even signal earlier. The rising trend here comes from connecting the RSI's lows over time. In other words, RSI values have been making higher lows on each pullback, creating a clear rising trend line on the RSI. Now, RSI is approaching this trend line again. This approach actually shows that the market is at a critical threshold, because in technical analysis, each test of a trendline support increases the probability of gaining new momentum. If RSI bounces upward from this trend line, it would not only mean a recovery seen in the indicator, but also point to the possibility of a strong rally on the price side as well. The reason is this: the rising trend structure of the RSI shows that buyer strength in the market is still dominant, and that sellers are not as effective on each pullback as they want to be. In other words, even though sellers attempt to put pressure on the market, buyers step in at higher levels and manage to push the price upward. This becomes visible in both the price and the RSI indicator. If RSI now bounces back upward from the rising trend support it has approached, this will be a signal that buyers have regained strength. Therefore, we are likely to see this signal reflected in price as well. The price will most likely launch a strong move upward with the potential to break resistances. Reactions RSI takes from trend lines often signal price direction in advance, because RSI measures price momentum and tends to react slightly faster than price action. Therefore, upward bounces from a rising trend on RSI increase the probability of price continuing upward. The bounce forming here could be not only a short-term reaction, but also a positive sign that price may strengthen in the medium and long term. Especially if RSI, after reacting to trend support, accelerates upward toward the 50 level and above, it could equal the beginning of a stronger rally on the price side. Another point to remember is that maintaining the rising trend on the RSI indicator is very critical in terms of investor psychology, because such trends generally increase investor confidence. As investors repeatedly see RSI bouncing from this trend line, they become convinced that this is a strong support and continue to support the upward movement of price. This leads to buying pressure intensifying in the market and price rising rapidly. In other words, RSI approaching this trend and bouncing from it is not only a technical signal, but also represents a psychological support zone.
The Elliott wave theory is one of the most important technical analysis approaches used to understand price movements in financial markets. According to this theory, prices move in certain patterns, and these patterns often reflect the influence of human psychology on the masses. In this context, the third wave of the pattern is known as the stage where the strongest and sharpest moves occur. Now, there is an interesting situation here. The price has already entered the third wave. According to Elliott's theory, the first wave is a beginning, the second wave is a correction, and the third wave represents the strongest momentum. If the price is indeed progressing within the third wave, this indicates a huge opportunity for investors. This is because the third wave usually offers the most impressive price increases in terms of both volume and speed. In this scenario, we are talking about the possibility of the price reaching the 2.272 level. Reaching this level means the price carries a massive upward potential of around 250%, which presents a highly positive technical outlook. In Elliott wave logic, the third wave is never the shortest wave. Most of the time, it is the longest and strongest one. When we consider investor psychology, during the first wave, most people do not believe the move is real. The price rises a bit, but many think it is a trap. When the second wave comes, the price falls again, and people believe they were right, so they close their positions. But it is exactly at this point that the third wave begins, and the price suddenly enters a strong uptrend. In the third wave, market confidence grows, investors re-enter the market, new participants join the market, and this crowd continues to push the price higher. This is why knowing that the third wave has started is a huge advantage. Setting 2.272 as the target is closely related to Fibonacci extensions. Investors who apply Elliott wave theory often include Fibonacci ratios in their analysis. The target for the third wave is usually one of the 1.618, 2.0, or 2.272 Fibonacci extensions. Here, the 2.272 level points to a particularly strong target. This ratio shows that the price could rise with extraordinary momentum, psychological resistances could be broken, and investors could be swept up in great enthusiasm. If the price reaches this level, we are talking about a 250% increase, which means the asset could multiply several times in value. Such a scenario could be a historic opportunity for investors. Now let's discuss why the third wave is so powerful. The third wave is actually the stage where investors accept the market's direction. In the first two waves, there is hesitation, doubt, and lack of confidence. But when the third wave begins, these doubts give way to confidence. The majority of investors accept that the price is in an uptrend. This acceptance brings in new capital inflows. Large funds, retail investors, and even institutional buyers enter the market during the third wave. This intense demand pushes the price sharply higher. Especially social media, news, and market commentary accelerate the move even more at this stage. The feeling of fear of missing out, or FOMO, is triggered in human psychology. This emotion makes the third wave even stronger. The possibility of a 250% increase here is actually consistent with the typical characteristics of the third wave. That's because third waves usually deliver the highest returns. Technical analysts know that third waves extend at least 1.618 times the length of the first wave, but sometimes this ratio can go much higher. In this scenario, a high Fibonacci extension, such as 2.272, is being targeted. This shows that the third wave could be an extraordinarily strong upward wave. In such a rally, the price could move upward almost in a straight line. Corrections would be short and shallow because the market constantly finds buyers. Selling pressure remains weak, while buying appetite is much stronger. If the price reaches the 2.272 level, this will be a turning point, not only in terms of technical analysis, but also in terms of investor psychology. Such a big increase boosts confidence in the market, attracts new investors, and strengthens the probability of the trend continuing. A 250% increase is the kind of return most investors dream of. For this reason, even approaching this level could create a new wave of excitement. As we often see in markets, the higher the price goes, the more new investors come in, and the more new investors come in, the higher the price goes. This is a cycle, and during the third wave, this cycle works very quickly. One of the important points here is this. When the third wave starts, usually very few people can take advantage of this opportunity correctly. Most investors hesitate to re-enter the market due to the losses they suffered during the second wave. But as the third wave progresses and they see the price constantly rising, investors slowly return to the market. But this time, they are already too late. That's why recognizing the third wave early and taking a position in the early stages is an incredible advantage. In this scenario, the possibility of the price reaching the 2.272 level comes into play exactly here, because this target is being projected while the third wave is still at the beginning, and this offers investors a huge opportunity. The beauty of Elliott wave theory is that it helps us understand not only price movements, but also human psychology. This is because the waves are essentially a reflection of the emotions and thoughts of investors. The first wave is hope, the second wave is doubt, the third wave is confidence, the fourth wave is caution, and the fifth wave is excessive optimism. If we are currently inside the third wave, we have entered the confidence stage. This confidence wave can quickly drive the price higher, and the 2.272 level can easily be reached. When this level is reached, a 250% increase is not only technically logical, but also psychologically consistent. In conclusion, according to Elliott wave analysis, the price entering the third wave indicates a massive upward potential for investors. The possibility of reaching the 2.272 level is strongly on the table, and when this level is reached, a 250% increase is quite possible. The typical characteristics of the third wave, investor psychology, and Fibonacci targets all support this scenario. If such an increase occurs, it could present a historic opportunity for investors. That's why it is extremely critical at this point to correctly analyze the power of the third wave, seize the opportunity in time, and be psychologically aware of the process. Because in such a scenario, most market participants will only act after it's too late, while those who notice early can achieve extraordinary gains.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.